Investors spy factors beyond US and Iran in commodities spike. Iran's retaliatory missile attack on US forces based in Iraq prompted gold and oil prices to spike dramatically on Wednesday, but investors believe there is more to the jump than simply fears over escalating risk of war.Oil hit $71 a barrel and gold demand reached fresh highs after Iran fired tens of rockets at bases holding US troops in retaliation to the US airstrike on the 3rd of January that killed Iranian General Qassem Soleimani. The oil price rise was short-lived as it soon fell back to about $69, while gold continued on an upward trajectory touching $1,600 per troy ounce before trading back marginally lower at $1,580. Geopolitical risk not being priced into oilWisdom Tree Associate Director, Research, Mobeen Tahir notes the Brent crude price has actually been steady since the initial jump from $66 to $69 in reaction to Soleimani's death. The fact Wednesday's revenge attack by Iran failed to materially move the price leads Tahir to believe geopolitical risk is not being priced into oil.He says in September last year, when Saudi oil facilities were the subject of drone attacks, oil spiked by around 10% and then retreated very quickly in the subsequent days. What we've seen is that every time there has been a geopolitical incident, oil has spiked and then returned very quickly to the pre-spike level. What that tells us is that a geopolitical risk premium which should be there in oil prices, is not. Whether or not markets actually move to do that is another matter, he adds. But we don't believe that at the current level markets are fully appreciating or pricing in the level of risk in the region. Knee-jerk reactions tend to mean revertCanaccord. Genuity Wealth Management Chief Investment Officer Michel Perera says geopolitical events will always move markets, but knee-jerk reactions tend to revert to the mean after the situation calms down. He adds, unless this leads to a ground war between the US and Iran, which is extremely unlikely, the current tension may well be seen as an opportunity to add to markets that otherwise could look a little pricey. Perera says it is supply that determines a longer-term price move. Price spikes due to events have more chances of sticking when supply is already weak, he says. In that respect, given that crude oil output has been falling in the past few months, there is a chance that Brent might trend toward the $70 level and stay there. From an investor's perspective, though, since 2015, there has been more of a small positive correlation between oil prices and equities, probably due to the lesser dependency of the world economy on oil prices. Broaching $100 would spark recessionary fears. Sigma Investment Management Head of Investment Strategy Rory McPherson says oil at about $70 is not an issue for the market, but if it continues to spike in the short term. For more on this story, visit the news article link.